Welcome to this video. In this part 1, we are discussing about the basics of international trade finance. In part 2, we can look at collections, part 3 on letter of credits, and the last part on the standbys and guarantees. The fundamentals, the basics of international trade finance. What's the history of trade finance? Trade has been in existence from the time lifestyle of mankind changed from being hunter to gatherer and farmer. Man started having excess of certain products and he found a desire for possessing something else. So having extra of something and having shortfall of something else gave rise to barter, that is exchange of your possessions. Discoveries from the ruins of old civilization and mentions in the literary works provide us enough evidence of cross-continental trade. What are the associated inventions? Stones, shells, bones, and horns were used as value after exchanging goods for barter. The use of gold of medium of exchange after exhausting the stones and shells. The bill of exchange as a store of future value was introduced. The traveler's letter of credit to carry the credit within us safely was invented. The correspondent banking relationships to fund against the traveler's letter of credit came into existence. Banking institutions were invented for financing the trade, and then came the letter of credit, the commercial letters of documentary credit. The standardization. The ICC, International Chamber of Commerce, developed and published its first version of the UCP-DC, Uniform Customs and Practices for Documentary Credits, in 1933. It was called the ICC publication number 82. The latest version that is in vogue today is UCP 600 that came into effect in 2007. What are the rules of trade published by ICC? The uniform rules for bank-to-bank reimbursements, the EUCP, the International Standard Banking Practice for examination of documents under the letter of credits, the uniform rules for collections, the uniform rules for demand guarantees, and international standby practices. So these are some of the important ICC rules. The risks in international trade. What are the risks? Trade is risky. International trade is still more risky because of the varied language and culture of the different places, the different laws and regulations in different jurisdictions, foreign exchange rate fluctuations, the currency translation and transmission risk, the credit risk of the counterparty or the bank that issues a letter of credit or the country with whom you are dealing with, performance risk of the intermediaries. Will the insurance company be able to pay you? Will the shipping company will be able to carry your goods? Economic, political and social risks. Maybe there is a ban on production or use of a particular goods, or maybe for political reasons. You might have seen some countries don't send potato across the border or don't import onion from the neighboring country. Then there is a physical risk to the goods. Not only theft, pilferage and non-delivery, but deterioration. And then comes the obsolescence, redundance and competition. So thus, the international trade is full of risks and the buyer and seller need to be aware of various measures to mitigate these risks. The countries form various blocs to promote trade, exchange of the goods. For example, the North American Free Trade Agreement NAFTA, the European Economic Area or the European Union, the African Trade Union, the Association of Southeast Asian Nations. Now, when just two countries need to have a bilateral arrangement, an agreement, then what they give is called a most favored nation status for the import from or the export to the specific friendly country. What's the process of agreeing for international trade? First, the parties have to identify a counterparty. Then they used to negotiate the commercial terms, the product specifications, as well as the shipment terms. Whether it should come by sea, what should be the product, how it should be packed, what would be the price, what would be the Incoterm, and when will be the payment made? Is it at site or say 180 days from shipment? The payment terms and the settlement method has to be agreed upon. Will it be paid under letter of credit or will it be under open account or collection? Then a sales contract will be drafted. The buyer may have their own preferred terms and conditions. Likewise, the seller will have their own terms and conditions. So when one party gives a purchase order and another party gives the pro forma invoice, these need not necessarily match. So the parties have to sit together and iron out the differences, and they also have to decide upon the jurisdiction and the applicable law, and whether arbitration and dispute settlement mechanism will be applicable, so that in case there is a problem in the commercial contract, how it will be settled. So there should be offer, there should be an acceptance, there should be an intention to agree, there should be capacity to contract and bind themselves, there should be consideration, and there should be consensus. The party should consent to what they are signing themselves to, and the purpose should be legally valid purpose. Only then the trade agreement will become a valid executable contract. What is arbitration? Parties to the contract agree to a specific method of resolving subsequent disputes if any. Is the jurisdiction friendly towards arbitration? Is the jurisdiction reputed for its ability for a fair, fast, and just decision? So these are main considerations while agreeing for arbitration as a method of dispute resolution. What are the minimum terms or the information that should be in an order or an acceptance? What is the nature of the goods? What are the specifications? Is it steel? What grade? How much thickness? What should be the chemical content? What's the price? What's the breakup? Is freight included? Is insurance included? Is it CIP or exports? In what currency is the invoicing happening? How it should be packed? Is there a need for a 5-days mandatory certificate? How it should be shipped? Is it by container or bulk break? Should there be an inspection? If so, pre-shipment or post-shipment? Is it sample or is it full? What should be the content of the inspection certificate? What quality checks are required? What should be indicated to ensure that the goods that have been inspected meet the specifications? What notifications are required? Should there be a notification of readiness of goods? Should there be a notification of readiness of the vessel to pick up the goods? What sort of insurance cover? What are the risks that needs to be covered? Is ICCC cover sufficient, or you want an A cover? Customs clearance. Who will be responsible? Who will provide the documents? Who will pay for? Who arranges the carriage? Who pays for the freight? When are the goods to be shipped? And when will they be paid? Under what? Under documentary correction? Under open account? How should the parties claim? Should they submit only an invoice, or is copies of tax invoice acceptable? And how will the payment be? Is it the payment based SWIFT? Should a check be issued? And what is the lead time? When should the LC be issued? How long will be the shipment period? How long will be the presentation period? And when will the money can be expected for the shipment made? These are the things that has to be made clear in an order of acceptance. Okay, now we have seen about the sales contract. Let us look at the role of banking, which is an aids to trade or a facilitator. What's the role of banking? Banking is supposed to help in making payment through secure channels in a reliable fashion, to collect the payments due, to be trustworthy and reputable, to ensure confidentiality and hold information, documents, and goods in trust, to make finance available at reasonable rates of interest, to charge reasonable fees for the services rendered, always act keeping in mind the customer's interest, and prevent and protect from fraud and crime to the extent possible. This is what the banking is expected to help the customers in an international trade. Coming to trade KYC and trade-based money laundering, trade is one area which is prone to or a fertile ground for money laundering, because banks deal only in documents and not in goods, so the values could not be established. So know your customer's business, know your customer's customer, bought from whom, sold to whom, the ultimate beneficial owner, what is the goods, what is the value addition that is happening, what is the process that the goods undergo, is it possible for dual use, and what are the ingredients, is there a chemical, is there a scope for weapons, what is the trade cycle, how it gets converted from the date the order is placed till the date cash is collected from the end customer, what is the cash conversion cycle, how much time the customer is out of funds, and what are the sources of funds, and how much he is borrowing from the bank, and will he be able to repay in case the bank steps in and finance. Estimated volumes, jurisdictions and parties to understand whether there are possibilities of phantom shipments or phantom invoices or phantom documents or phantom goods or non-existent parties. Forged signatures, falsified documents, risks are there which needs to be kept in mind while dealing with a customer having an international trade routed through a bank. And then comes the risk of non-existent or fake parties or goods or documents which may lead to the bank getting cheated. What are the trade services? The trade services are the facility by a bank to a customer to handle the documents and collect the payments for the same. Assure payment against evidence of compliant shipment, which is mostly under letter of credit, while handling documents is mostly under documentary collection. Banks also guarantee that a customer will fulfill the obligations to the counterparty. So this is a guarantee business or the bonds or the standbys. And then banks provide finance and discounting services. This is to bridge the working capital gap. So these are the services, trade services that a bank industry provides to international trade. To look into more detail, direct payment is a type of payment method where goods are shipped by the supplier, expecting payment at a later date from the buyer. It is the highest risk to the exporter because you are parting with the goods without having sight of the payment. Documentary collection. Goods are shipped and documents are given to the bank for delivery against acceptances. Medium risk to the supplier. The buyer may or may not pay after getting the documents released against acceptance. Then comes the documentary collection where the documents are delivered against payment. So this is called a DP. The other one is called DA, documents against acceptance, and this is called DP, documents against payment. Here it is still lower risk because the buyer will have to pay for if he wants the documents, which will give him possession of the goods. The risk is that if the buyer is not willing to pay and take up the goods, the supplier will have to store, reship, and resell the goods. Documentary collection. Goods are shipped and documents are submitted to the nominated bank. Now these documents under a documentary credit will provide adequate evidence that the terms and conditions have been met. And so if they are compliant, the supplier is guaranteed of the payment. As far as the buyer is concerned, he gives a guarantee that payment will be made only if the specified terms are met. He is also satisfied that definitely the goods will arrive if money is going from his account. In documentary collection, we have a co-acceptance where the usance bill or a deferred payment bill is accepted by the bank in addition to the acceptance of the buyer, so that on due date, if the buyer's account is not funded, the bank becomes liable to pay under a documentary collection. In a documentary credit, the exporter's bank add their own undertaking in addition to separate from and independent of the undertaking of the issuing bank. And so what happens is, the buyer gets a confirmation of his own bank that payment will be made if documents are compliant. Irrespective of bank risk, irrespective of country risk. Then comes the advance payment where goods are shipped by the supplier after getting their payment in advance from the buyer. The risk is least for the exporter and highest for the importer because importer parts with the money with the expectation of goods which might come in future. So in case of an avalized documentary collection, in case of a letter of credit, and in case of a confirmed letter of credit, there is an additional undertaking by the bank to protect the payment for the supplier. Now let us have a look at the international commercial terms. These bring clarity on when is the delivery obligation complete, when does the risk pass on from the seller to the buyer, who will bear which portion of the carriage, ride, insurance, etc. It does not talk about when does the title pass on and what happens in case of breach. Effective January 2020, the new form of Incoterms is coming into effect. The most popular Incoterms are ex-works. Ex-works at a given place, which is normally the supplier's place. For example, the gate number 3 of the shipper's factory. Seller places the goods at this place. The buyer gets it loaded and carries it away. Ex-works is all risk to the buyer. From the moment the supplier places the goods at this point, the supplier is no more responsible for anything. FOB, free on board at a given place. This is normally the port on the supplier's country. Seller places the goods loaded onto the carrier nominated by the buyer at the port near seller's country. From this point onwards, the buyer is responsible for everything, including risk of loss, the freight, the insurance, etc. CIF is the most popular term. Cost, insurance and freight at a given place. This place is normally the buyer's place. So the seller will arrange to pay for freight and insurance up to this place, and he is responsible to ensure that the goods reach there. His risk is over the moment he hands over the goods to the carrier. Seller arranges to deliver at this place by providing insurance cover for the transit and freight for the carriage. But he need not carry, he just need to hand it over to the carrier at his port. The risk passes on when the goods are loaded onto the, for example, the ocean-going vessel. DDP is another popular encoder, which means delivered duty paid at buyer's place. This is important when customs duty is applicable, and including the customs duty to import, every expense is met by the supplier, and the supplier has to ensure the goods are placed in good order at an inland place nominated by the buyer. It is all risk to the seller. The most extreme case, which is exactly opposite of the X works. Let us have a look at the documentation for international trade. The most important document in international trade may or may not be applicable, but it is very important. These are the license for import or license for export. This license will be for maybe prohibited goods or restricted goods or dual use goods. License to deal with sanctioned entities is also a requirement in today's economic environment. Banks deal only with documents and not in goods. Banks deal only with documents and not in goods. That is why these documents are important. Banks are not liable for the genuineness, validity, accuracy, or sufficiency of any of the document. Banks do not vouch for the contents of the document or issuer of the document. Banks deal only in documents. This is the most important thing. Negotiable instruments. Checks, promissory notes, demand drafts, banker's check, bill of exchange are all called negotiable instruments. They are called negotiable because they transfer title by endorsement and or delivery. The value can be transferred, and it can be transferred for value received for consideration, and holder in good faith gets all the rights to claim the money. These are used by the buyer and seller to ensure values transferred from one party to another on or before the due date. Among the documents used in international trade, shipping documents are very important. These are the documents that evidence transport of goods and the documents that evidence sale. Invoice is a document that evidences sale, and the bill of lading or the bill is a document that evidences shipment. Shipment or dispatch will be required, and it has to be evidenced in the documents called for by either the documentary collection or a documentary credit. An applicant will usually require these documents to obtain clearance and delivery of the goods upon arrival at the destination port. These are usually documents of title and has control or gives possession to the goods. These also serve as transactional collateral, allowing negotiation of value, and so banks would be interested in getting these documents from the supplier till the buyer pays for it. Bill of exchange, which we have seen earlier, a negotiable instrument, is also called a draft. It is an unconditional order in writing addressed by one party called drawer to a certain party called drawee, signed, that is accepted or committed, and it requires the addressee to pay. Pay what? Pay on demand on a certain future date. Pay on demand or on a certain future date, that is called the due date. A certain sum of money, that's a legal tender, you cannot just give gold coins. And it is to the order of a specific person or bearer, that is a pay. This is a bill of exchange. This is subject to Negotiable Instruments Act, and so this negotiable instrument is used widely all along in international trade. But recently, Chamber of Commerce has come out with a white paper to recommend banks to do away with dealing with bill of exchange because of the changes in legislation, because of the cost involved, and because of the discrepancy they give rise to. Coming to transport documents, there are two types of transport documents. One are quasi-negotiable and one are non-negotiable. Each mode of transport has its own internally accepted rules and terms of carriage. Usually, transport documents are issued by the carrier, the shipping company or the forwarding company, who acts on behalf of the shipping company to carry the goods from the inland point to the buyer's place. The transport document is an evidence of contract of carriage. It's an evidence of receipt of goods for shipment. It's an evidence of what moves from where to where and how and when. Transport document is an evidence of what moves from where to where, how and when. It tells who is the shipper. It also tells who is the carrier and who is the consignee to whom the goods will be given to. It conveys title to the goods. It gives right to possession. It provides control over goods. These are the significant points of a transport document. That is why mostly banks call for the bill of lading consigned to the order of the bank of the buyer. What are non-negotiable or not quasi-negotiable instruments? These are seaway bill, airway bills, Chatapati BL or a house or a forward BL, road or rail transport, courier or a postal receipt. These are not documents to title. These do not give possession of goods. These do describe the shipment details and are contract to carriage and are evidence of movement of goods, but they are not evidence of title to goods. Goods are leased to the named consignee without waiting for the original instrument. Insurance is another document. What are the negotiable instruments? Negotiable transport documents are port-to-port BL or a ocean BL or a multimodal BL. What is a multimodal BL or a through BL? When shipment is happening from an inland place or container depot or a container terminal to an inland place or a container depot, when it is not port-to-port, then multimodal BLs are used. Multimodal means more than one mode of transport. Land is one mode of transport, air is one mode of transport, ocean-going vessels are another mode of transport. A ship is called a means of conveyance. Aircraft is called means of conveyance. So when goods move by truck up to a port, and then by way of a vessel to another port, and then by aircraft to another place, this means three different modes: road, sea, and air has been used, and it will be evidenced in a multi-modal bill of lading. Insurance. Carriers have limitation clauses in the contract of carriage, and compensation are usually low. So just because we have entrusted our goods to a shipping company does not mean the carrier will pay us if the goods cannot be delivered. That is why cargo insurance during transit is vital. TPND stands for Theft, Pilferage and Non-Delivery Clause. SRCC stands for Strikes, Riots and Civil Commotions. Sometimes people ask for war risk or piracy risk depending upon in which area the ship is expected to fly. The level and nature of the insurance cover is internationally codified as general cargo clauses. Level C covers the risk of loss of the means of conveyance, that is, the ship sinks, the rail gets derailed, or the aircraft explodes. Level B covers level C plus natural calamity like an volcano, earthquake, or something causing damage to the vessel or to the goods. Level A covers level B plus theft, etc. That is damage to the physical goods. This is how the insurance cover is there. The minimum expected cover is 110% of the gross value of the goods shipped, not necessarily depending upon the value that is claimed by the supplier from the bank or buyer. What is not covered in insurance? If some cargo is jettisoned to save the ship and other cargo, all those with cargo on board the ship should share the loss, even if their own goods are not thrown overboard. This is the general average rule. If I and you send some goods on a ship, and because of one of our goods is creating excess load on the ship and they want to throw it away on the sea to save the ship and save other cargo, then general average means everybody who had cargo on the ship will share the loss incurred by the person whose goods have been thrown overboard. So this needs to be kept in mind while arranging for insurance if the bank is funding the buyer or seller against the shipment. The insurance cover does not cover the risk of insolvency of the carrier or seaworthiness of the vessel or failure in having good packing, etc. So if you expect things to break, it is better to ask for proper packing. Insurance policy is a comprehensive document. While insurance certificate attends to specific shipment under the general long-term policy. So it is not necessary every shipment will be covered by an insurance certificate. Insurance policy, it might be possible that only insurance certificate is there, which will refer to the specific shipment and say the cover will be as per the actual already issued insurance policy, which is in favor of the party who is called the insured in the transaction. What are the other documents that are used in international trade? The most important one is the commercial invoice, which is evidence of sale. It must be drawn by the supplier or the shipper, the beneficiary of the LC, and it will be drawn on the applicant or the buyer. It will indicate the itemized price, the unit price, the goods, the Incoterm applicable, the way of calculating the price, how much is payable now, all those things. It will have a goods description, which will be corresponding to the description in the letter of credit if applicable. The invoice is an evidence of sale. It may not be signed. The other documents are certificate of origin, which are necessary to get tax concessions at the customs point. Depending upon the origin of the goods, in the export and import point, a different tariff might be applicable on the goods. Then comes the inspection certificate, quality certificate, weight certificate, and test certificate, which will help to satisfy the buyer that what has been ordered has been shipped. Collateral or security. BL as a quasi-negotiable instrument provides title and control over the goods to the bank. Trust receipt is an agreement to hold goods pledged to the bank as security and so permit the buyer to take possession of the goods without payment and keep the merchandise and proceeds of the sale separate and distinct. So when a buyer takes the goods from the bank, he is saying that he will keep the goods, the proceeds of the sale separate and distinct, and these will remain pledged to the bank till he pays for it. What are the tools and instruments used in international trade in the form of trade services offered by bank? Open account services, that is advance payment and direct payment, documentary collection services, documentary credits, standbys or the guarantees. These are one. Why are these instruments or services of the bank used by traders? Because the buyer and seller have different choices, different expectations, different requirements. The supplier's choice is to receive the payment in full, in advance, before parting with the goods. The buyer's choice is to pay only after getting possession of the satisfactory goods. So their compromise is required due to the underlying commercial nature of the trade. So the buyer cannot keep on saying, I will pay only after sighting the goods. The seller cannot keep on saying, I will supply only if I am paid. So these services from the bank in the form of trade services or instruments are required. What is assignment and transfer? The proceeds of the claim under a letter of credit or a letter of guarantee are assignable. The proceeds of claim, the money, if any, due under LC or LG, can be assigned in favor of maybe the bank who is financing the buyer or a seller, or maybe to any other party. What is transfer? Documentary credits and standby credits can be transferred to another party who will get a right to perform under the transaction. So if a documentary credit is transferred, the transferee beneficiary will perform under the credit and if found compliant will become eligible for the money. We will take a break here and in the next session we shall discuss documentary collections, which is a popular form of trade services used by buyers and sellers.